My name is Aydan, graduated from Tehran University in the field of business management. Today we are going to talk to you about the importance of risk management in life insurance actually. First of all, I want to define the risk. What is risk? Risk, in a simple definition, is uncertainty. If in a community the uncertainty level grows up at the same time and at the same level, the uncertainty causing the marketing of insurance also growing. So, by this way, we should understand that risk is a reason of being for insurance. Through risk insurance and also through insurance contracts, the customer, I mean that insured person, seek the persons or seek the insurers to transfer the financial uncertainty in exchange for a set of premiums levied by the insurers. Life insurance contracts provide a protection in the event of life, death, longevity, morbidity, health care, and the care of costs. The contracts of other parts of insurance provides such as car accident, storms, fire, and something like that. For example, in this case, we should consider the property of a person. Therefore, it is to be understood that risk managers should manage the level of risk in the case of identifying, assessing, analyzing, and also controlling of this risk. And the rate of premiums must be understood in this way. So, our paper discusses about the importance of risk management and also the selecting the best and suitable way to understand and select the insurance premiums by this way. First of all, we should point out our details in PowerPoint, and after that, about marketing risk, my colleague Elahe will continue. So, in the first PowerPoint page, we have market risk management framework in a three-part or three sections. First of all, set objective. In this case, we have a definition, the risk applied in terms of asset liability management policies for asset supporting the policy obligations. The second, identifying risk. In identifying risk, we should have the principal sources of market risk are interest rate risk, inflation such as inflation and equity and also property risk, and something like that are discussed. And also in the third part, assess risk. In assess risk part, we have when the market risk of liability is compared with the market risk of the asset used to support the rate market risk of these liabilities can be measured. The next page. We have a description about the characteristics of the constructed scenarios. In this part, we have these three sections. First of all, interest rate, as inflation, I told it before, and equality returns, and also inflation. In the first part, we have normal yields must remain positive and not increase. Identity are subject to mean revision, but the revision target is not constant. And also the main and major points is high correction between maturities. In the second part, equity returns, we have negative skewness and fat tails over short periods. And also the other major point is price appraisal versus divided income. And also, in final part, we have realized may equal expected plus exogenous shock, and also volatility clustering, and finally a relationship to other economic factors. In next slide, we have operational risk. In this case, we have through operational risk exists in all enterprises, the first and key points. And the second of this point is initially developed by the British bankers, for example, association adopted with the banking sector, because bank and insurance have a close relation between together. At the same time, in last case, we have, as this definition points out, in executive process, people and systems can be a source of loss. Insurers and their supervisors should therefore practically and comprehensively address weaknesses that may create operational risk. And the next slide, we have operational risk management framework. In this case, we have 4 parts of section. Firstly, set objectives. Secondly, identifying risk. And also the third, assessing risk. In the first case, we have 2 parts. The first part, objectives for leading insurers at the board level are likely to focus on. And the second, other objective, especially for those insurers implementing an operational risk management framework for the first time. As you know, life insurance is divided between 3 or 4 parts. Majorly, we have term life insurance, permanent life insurance, universal life insurance. And these kind of insurances separately meets the definition that operational risk management framework must be needed to operate to this kind of risks and insurance.